Hello and welcome to Live Wire Markets. My name is Chris Conway. On today's Views from the Top, I'm sitting down with Andrew Schwartz. Andrew is the Group Managing Director and Co-founder at Qualitas. Andrew, thanks for sitting down with Live Wire today.
It's good to be here. Thank you.
Qualitas is a pioneer of Australia's commercial real estate market, established 15 years ago in Melbourne. You've personally been in the market for more than 40 years, Andrew, experience in property finance, covering multiple cycles. Can you just briefly explain to the audience the drivers for starting Qualitas?
Yeah, well, certainly the way you ask the question makes me feel old, but you do learn a lot over 40 years of being in the industry, and you do realise that there are cycles, and the really important part about what we do is about picking the right time of the cycle to really get involved. And we started the company in 2008, which all the listeners will know that was right in the middle of the GFC, but in many ways was the perfect storm to get a business like Qualitas up and going.
Private credit, it's been fast-growing segment of the market. What has driven this growth, and do you expect it to continue, slow down, accelerate from here?
I think a couple of things. Firstly, there's just a greater awareness of the asset class, and for a lot of investment managers, asset allocators, it's really on the radar now of areas for them to invest in. But we shouldn't be surprised by that. You know, we're going through a period of rising interest rates. We've had a 4% increase in interest rates over the last few years. And what comes with that is a lot of volatility in equity values. So a lot of participants in the real estate market in particular are left wondering about asset prices, the possibility that within a rising interest rate environment, you might find equity values actually come down. So looking for alternative ways to have exposure to property, but not necessarily be exposed into the equity side of property.
When things grow quickly, Andrew, it's not always a smooth ride, as we know. There have been some pockets of concern, particularly around the construction sector as it relates to property loans. What's your take on this broadly, and then what does Qualitas do to steer clear of those problem parts of the market, shall we say?
Yeah, outside of the four major trading banks, Qualitas would be one of the largest lenders to construction industry in the country. And we're very experienced in the area. It comprises at least 50% of all of our activity. And again, with rising interest rates through higher inflation, we shouldn't be surprised that construction contractors have been under cost pressures over the last few years. And the way the system works in Australia is with fixed time price contracts. A lot of those contractors have really felt the pinch because of the economic circumstances they're in. I'd say foremost that's really been in the house and land area, the volume builders. Qualitas doesn't really have a lot of exposure to that area. You know, we're mainly focused on high density residential construction. We have quite significant exposure to that type of area, but we're really dealing with tier 1, tier 2 commercial builders who have quite substantial balance sheets, cash reserves. We're very focused on their track record. We get into looking at how they're offsetting their cost risks in the sub-trades and how much of the contracts have been let before we actually get involved. There is quite significant contingencies associated with, from the builder side, in respect of pricing the contracts. We get bank bonds that also protect us in respect of the contracts. So it's a really forensic analysis of who the builder is, what their track record is, what financial support are they giving to the project, and it's really core to our business. And thankfully, our track record is particularly strong in this area.
Andrew, I imagine as well, sorry, just a follow-up question if I may.
Sure.
That's an ongoing assessment, isn't it? It's not like you draw a line in the sand, or you obviously have had these relationships for a long period of time, but they're constantly evolving and you're constantly reassessing the landscape, I would assume.
Exactly, in a couple of different ways. So firstly, we're constantly assessing the financial strength of the builders who we deal with. And so that would involve looking at what other projects they've currently got on the go, looking at are they on time, on price, Are they cash flow positive in respect of projects that Qualitas is not associated with, to really check for any contagion risk that they might be bringing across to our particular project. But for the ones that we've committed to, it's definitely not a set and forget analysis. We're very much focused on every single month looking at what we call a cost to complete test. And what that involves is actually looking at how much got spent on the project. You do get an independent quantity surveyor who goes onto site, looks at both labour and materials that have been spent for that particular month. They certify that to Qualitas that those costs were expended. And then they run, and the cost to complete test is to actually say, and there's sufficient budget left in the project to ensure that this project actually hits completion.
Andrew, just another follow-up question there, if I may. Deal flow lately, how has the deal flow been? And of the 100 deals that are coming across your desk in a given period of time, how many is Qualitas going after?
I'll take the last part first. So of the 100 deals, we probably do 5.
Right, okay.
We're very discerning, and we do get very significant transaction flow given who we are and the understanding of the brand, and also the capital that's available in the marketplace. And now I'll answer the first part of the question, which is really around just the volume of deal flow that we're experiencing. It is relatively strong at the moment, and that's going to be surprising to a lot of people, particularly those that are looking at the commencements of high density development, townhouses, terraces, where you can see that really since 2017, the Australian market has been experiencing every year on year, a reduction in commencements. But notwithstanding that, a firm like Qualitas has been growing relatively strongly. And the reason for that is because the banks, the more traditional financiers, have been narrowing in terms of their scope, and also the borrower market is really coming to understand what a firm like Qualitas brings to the market by way of greater flexibility in meeting borrowers' needs. So our business continues to grow, notwithstanding the fact that the market by way of commencements has been contracting a little bit.
Andrew, a lot of time is spent predicting the next move in interest rates. It's almost a national pastime these days. Doesn't really matter for Qualitas because you've got exposure to floating rates. Can you just talk through investors, how that works and why that is an important part of your investment process and opportunity?
Yeah, really interesting question. Firstly, I would say it does matter
Okay.
what happens with interest rates, because we're ultimately taking mortgages against property, and those property values are affected by movements in interest rates. And so, and asset values, property values behave differently in different parts of the economic cycle, and certainly in different times of interest rate movement. So watching interest rates is actually very important to us. Also for the serviceability of loans by borrowers is very much dependent on the all-up interest rate. But it is true in terms of saying that groups like Qualitas really play the credit margin. So our investors, particularly our institutional investors that represent about 82% of all of our total investors, look to how much margin can we earn over the risk-free base rate from our borrowers. So it is about the credit margin, and our all-up rates will increase or decrease with movements in base rates, and what they're really focused on is the risk margin that a group like ours is able to achieve.
Andrew, what do you think is one risk that the market isn't talking about enough at the moment?
Private credit's become a really interesting part of the market, and it's almost like it's had this discovery, which I love on the one hand, because I've been espousing the virtues of private credit literally for 40 years, but particularly for the last 16 or 17 years since we started Qualitas. And I think that because in a lot of investors' minds it hasn't yet evolved and it's relatively nascent, everybody sees it as a homogenous risk frame, right? That everybody says, well, if you've got a first mortgage, then aren't first mortgages, like it's this homogenous commodity that we're all talking about. And like all markets, there are markets within markets. There are different types of first mortgages, different borrowers, different regions. If you're dealing in residential property like a Qualitas is dealing in, it can be really around the design of residential property, its location, its market acceptability, how much leverage have you got against it. And I think that investors haven't yet really developed to a point where they're able to be discerning about various mortgages. So I think the risk that they run is they look at one manager who might be earning 8, 9, 10% returns, and they compare that to another manager who maybe is earning 11, 12, 13% returns, and they say, well, surely the one who can earn more is outperforming the one who earns less, without really understanding that there is actually no free lunch when it comes to lending. And there are reasons, very solid reasons, as to why one party earns X and the other party earns a premium over that particular number. And I think that the market probably needs to evolve where investors can be more discerning and understand the relative risk premium that private credit managers actually earn.
Andrew, just a follow-up question there, if I may, because I think it's an excellent point that you've just made. How hard is the conversation with investors and getting them to understand those nuances that you were just talking about? Is this something that you've found easier as we move further through the interest in private credit?
I think it's still relatively new for a lot of people. So even though for people like us, literally we've been dealing in this market for decades, not said lightly, for a lot of other people it's relatively new. So, there are higher returns if you're prepared to take more risk. So more risk meaning you might take on higher leverage, you might take on secondary locations, you might be dealing with borrowers that are non-bank-like borrowers versus somebody else, and I would put Qualitas into this category, that would say we're not trying to push the leverage, we're looking to work within highly densified areas of the major East Coast cities of Australia, with lower leverage, better borrowers, but offering more flexible solutions. And I think it's going to take time for investors to understand the differences, the nuances between the types of risks that they're being asked to accept. I think it will happen, but it's just a matter of time for people to better understand that.
Andrew, similar train of thought here. The biggest question you've been getting from clients recently, what is it and how have you been answering it?
Probably the biggest question is around the sustainability of the market, and looking at Qualitas, where we've been growing in a disciplined way, but very high growth. We IPO'd our business in 2021 when we were $4.1 billion. Our last reported FUM was over $8 billion some 2 years later. So clearly, as a group, we're experiencing high growth. And probably what investors are asking me the most is that just sustainable in terms of your outlook and your growth rate? And what I've really been pointing to explain that is around the size of the residential market in Australia, where in one way or another, whether it's our private credit business or whether it's our build to rent business, because we've got a very sizable exposure under the brand of GQ that operates in build to rent, we think it is a very deep market. And in fact, just some recent studies we've been doing, if you look at a study that was undertaken by CBRE recently, they said looking out between the years of FY25 to FY28, Australia will need 300,000 high density dwellings. So that excludes house and land. It's basically talking about apartments and terraces and the like. And another study undertaken by Charter Keck Kramer over exactly the same period of time talked about a need, identified projects equaling 79,000 projects that you could actually point to them and say, they've got their planning permit, they're likely to get finance, and that'll be a development over the next 3 years, which leaves simple mathematics, a shortfall of 221,000 dwellings. Now, to put that into more normalised English as to what does that all mean, if you just take the 79,000 of identifiable projects and you exclude those that are going to happen next year, because we can quite easily make an assumption they've already been financed or have a finance approval in place. So you just focus on 2026 and 2027. That's $40 billion of future debt capital that is actually required. And if you want to take the next step and say, what about the ones that we all need that are yet to actually be identified, that's over $200 billion of private credit, which happens to be 3 times the size of the entire Australian banking system in CRE credit. So I think that really does demonstrate this is a deep market. It has a very strong need for debt capital, and I don't think investors should be too worried about the runway being too short for a firm like Qualitas.
Andrew, just a very cheeky one. We both hail from Melbourne. What's happening with Melbourne apartments at the moment? Is there going to be any growth anytime soon? I ask because I may or may not be an apartment owner in Melbourne.
Yeah, I think actually Melbourne's starting to experience some growth. Right. And it's actually really good you asked that question, because the problem of the market for the last couple of years is you've had this desperate need for new supply to come into the market. As you know, vacancy rates have been running at sub 1%. You know, many parts of Australia, not so much Melbourne, but certainly Sydney and Brisbane, you're starting to see values rise between literally 5 and 10% on apartment values, and you're seeing rents increase by a very similar number. But if you come back to your Melbourne question, we would say to have a feasible project in Melbourne, you need revenues to be about $14,500 to $15,500 per square metre of realisation value to really deem a project. If you take the cost structure, the interest, the land values, you know, that's the range that you need. Now, for a long period of time, Melbourne has been trading below that, and literally in the last 2 or 3 months, we're starting to see projects being released into the market in excess of 16,000 a square metre that have been selling really well. And when I say really well, 40% of the project has been sold out in the first month of it actually being launched. And it's been quite a long time since we've seen that in Melbourne. So I think that goes well for the market. I think I would describe that as being the green shoots of the next cycle of the market. And it's something that we should all feel quite optimistic about.
Bit of hope there, yeah. Thank you. Last one for today, Andrew. The segment that we're participating in is called Views from the Top. So what is the one thing that you've learned over your extensive journey that you wouldn't have learned if not for the position that you hold at Qualitas?
Just be wary of the cycles. You know, don't think of private credit as being able to traverse all cycles, and you know, it's the cycle is irrelevant to what we do. Nothing can be further from the truth, and a lot of it goes to the discussion we've been having around interest rates and how real estate fundamentally behaves at different parts of the cycle, whether that be high rates, low rates, a lot of liquidity in the market, low levels of liquidity. Don't ignore the cycle, it's really paramount. And I think the secret sauce of private credit is be really focused on the micro of what you're doing, but don't take your eye off the macro either.
Fantastic. Thanks so much for sitting down with Livewire, Andrew.
It's been a pleasure. Thanks for having me.
If you enjoyed that Views from the Top as much as I did, make sure to give it a like. And don't forget to follow our YouTube channel because we're adding lots of great content every single week.